Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Zia Uddin, President of Monroe Capital. Zia, really appreciate your time. Thank you for coming on the show. How are you doing today?
I'm doing very well. Thanks so much for having me on, Todd.
Of course. So, I feel like I have to kick off with, we've had a bit of a chaotic start to the year, given the new administration, and volatility has certainly been, one of the buzzwords thus far this year. Does the volatility change how Monroe thinks about its strategies? Does it reinforce what you've done with your strategies? Kind of how do you guys think of the volatility that we've seen thus far?
Yeah, it's a great question. So I was overseas on a fundraising trip, and I just recently got back, and this was a topic that a lot of people asked about. What I was saying about kind of the volatility that you're experiencing or what people are seeing is the administration, the president talked about all the things he was going to do prior to him being elected. So from Monroe's point of view, we weren't really surprised. Now, the speed at which he did it and some of the things that he did, I think, caught us a little bit off guard. But we're long-term investors. We're senior secured lenders. So typically, we're underwriting a company for a certain value, and we will lend to a certain portion of that value. So most of the companies we deal with, they don't have international supply chains. They aren't subject to tariffs as much as these multinational larger companies. So the companies we tend to lend to and to fund are what we call middle market companies. So these are revenues between kind of 10 million and 400 million. And so these are companies that operate in a $1 billion, $2 billion market size. They're usually the 1, 2, or 3 player in the space. So they have U.S. customers, U.S. dollar denominated, cash in and out, and U.S. supply chains. So from that point of view, a lot of the volatility generally is an opportunity for folks like us, because in our history over 21 years, good companies always need capital. And so you'll find a handful of companies every year that fit that category and fit the profile of what you want to lend to out of 200,000. So for our point of view, it create some opportunities. You obviously have to have your head screwed on straight and make sure you do the proper underwriting. But if you do your job right and you have the experience doing it, generally it's a net positive.
We just had a direct lending event a couple of weeks ago down in Nashville, and there was certainly a lot of talk around the growth of that market. Obviously there's lots of different things happening in private credit these days. Can direct lending handle a 50, 100% growth over the next 3 years? Will we get to a point where there's too much capital chasing too few deals?
Yeah. So I've got a great answer on this. The answer is yes, no, and maybe. And the reason I will give you all three, and I know I'm right on one of them for sure, is that if you look at the upper market, direct lending market, I think the answer is no, because that market is fully saturated, in my opinion. Obviously, I have a personal bias given where we play, but it is, to me, beta. It's cheap beta. And so there is very large firms that are really good at what they do, and that market, I think, is fully vended. So if the question is directed toward kind of the upper part of the market, I think the answer is, yeah, I don't see how the growth in that market can continue. If you're talking about other ancillary segments, I think the answer is yes. And so, the way I think of it is kind of, if you look at a bicycle wheel, a hub and spoke model. I think the hub being kind of upper market direct lending, that's kind of the core product. But where you're seeing the growth coming in would be more like asset-based lending or lower middle market lending, or unique strategies where I think there's still some headroom. Right now, everything I've read says it's a 1.7 approximately $1 trillion market, and that's supposed to double. To your point, I do think there's opportunities. I just don't think it's in the same categories as what has been done in the last 10, 15 years.
Tell us a little bit more about, you've referenced kind of where you guys play, a little bit more about Monroe. Is there
Yeah.
particular strategies you're seeing, kind of your biggest growth? How diversified are you today from maybe where Monroe started? Tell us a little bit more about the
Yeah.
firm.
Yeah, for sure. So the firm was founded in 2004. I joined in 2007. The way I would call ourselves is we're an asset manager. And so the way I interpret that term is my job and the firm's job is to provide products to LPs that they may not have access anywhere else. So if you look at the core competencies of the firm, I think what we do well is we focus on the inefficient part of the US market, which is lower middle market, right? So I mentioned there are about 200,000 companies with revenues between 10 million and $1 billion in the US, and we're trying to do 50 to 60 of those deals a year. So if you build the infrastructure and you have the experience, then I think you can take advantage of that inefficiency. So we have approximately 300 people at the firm today. We have 29 originators that are all employees of the firm that go out and hunt for these deals. So we'll look at a couple thousand of these deals a year, and we'll try to find 50 or 60 that makes the most sense for us. So part one of what we do is we want to tread in an area where there aren't a lot of people wanting to focus because it's inefficient. You need bodies, you need a lot of infrastructure to take advantage of it. Now, in our experience, you get paid for that. But a lot of people look at us and say, hey, you guys manage $20 billion. You have 300 people, seems like a lot of work. And they'd rather, have less people and try to deploy more capital. But that's that upper part of the market that I talked about. So if you look at kind of our core competencies, the market we play in, and then two is I do think that originations is a differentiator. So a lot of folks or a lot of the peers that we have, they may not have the built out 29-person infrastructure that we do. They may have a couple of folks on a Bloomberg terminal calling for deal flow or going through club transactions. But the thesis that we always had, which was going back 20 years, is if you can originate your product, then you can be more of a market maker as opposed to a price taker. So if you can make a market, then you can dictate things like structure, pricing, covenants, documentation, and so on. So for us, it was really important to build out that muscle, and having 11 offices across the world to do that. And us having the bodies to do that is a big difference for us. So if those are kind of the two basic foundational, I think, things that we focus on, then you can create a couple different strategies or a few different. So we have a middle market CLO strategy. So that's a little bit different than what most CLOs are, which are broadly syndicated. We have a lower middle market direct lending strategy. We have an alternative credit strategy. So think of that as asset-based secure lending. So this is things like specialty finance, litigation finance, NAV finance. You'll see some structured real estate in there. We have a software lending business. So we've done over $10 billion in that in our history. So we have that strategy, all kind of lower middle market focused. We have an independent sponsor strategy. So this is a hybrid strategy where we're partnering with independent sponsors coming out of let's say a $10 billion private equity firm. And for whatever reason, they don't want to go fundraise their deal guys or gals, and they want to just do deals. So they look to us as a one-stop shop. So they want debt and equity. And so we'll provide that to them, and they have limited partners that they bring to the table for the equity.
Liquidity, unlike the public markets.
Right.
How do you see that evolving over time?
Todd, if you and I could figure this out, we'd be on an island on the beach, making a
Let's
ton of
figure it
money.
out.
So this, yeah, let's figure it out. This to me is the holy grail because you have a ton of these private credit firms that started 10, 15 years ago. They haven't wound down their funds. And this whole secondaries market I mean, it's ripe for some solution. Now you're starting to see some of this, whether it's continuation vehicles, whether
Hmm.
it's secondary processes. I think it's the tip of the uh, iceberg here. I think there's a ton of opportunity there, and I think you're going to see more of it. What's going to accelerate it, in my opinion, is a lot of the private equity firms, they haven't been able to return capital to their
Yeah.
LPs. And so the LPs are upset about the PIs at the PE firms. And now I'm hearing the PE firms average fund is not 10 years, it's closer to 14. So they have that problem on the private equity side for those allocators. On the private credit side, they're going to start seeing the same thing. So the industry is going to be forced into some solution. These funds that have closed end terms and they won't be able to get out of those terms, there's going to have to be a solution. So whether it's tradable or whether it's more secondaries, who knows? I think you have to, it's tough, in my opinion, to be able to assess someone else's loan without having some inside knowledge, either
Yeah.
kind of your understanding of underwriting or your view of valuation or so on. You have to do some bottoms up company fundamental analysis, and then you could price the book. But it's opaque, right? So there is some
Yeah.
art to it. There's some science to it. And I think that market will continue to evolve, but you'll probably not see a very small bid ask. I think you're going to see, until there's better information, probably a slightly wider bid ask spread.
I know, part of your role, as you referenced earlier in your answers, the assisting software technology
Yeah,
enabled businesses. Clearly, the other buzzword that's probably bigger than anything else these days is AI.
right.
And so, how do you view the AI boom? There's been a lot of opinions around this. How does it view how you look at maybe companies and how AI might impact that sector that you're lending into, or AI
Yeah,
can maybe help some of your processes? You mentioned 29 originators. Does AI help, accelerate those
right.
29 innovators? How do you view AI?
Yeah. So this is a great question. Internally, we had an AI committee that's looking at this. I've spent a ton of time looking at it. And here's the fact of the matter, at least from my perspective. No one really knows. And we're taking more of a wait and see attitude for AI internally at the firm. So there are things that we're doing, but like if you're asking, are we all in and spending tens of millions of dollars on the AI? I think the answer is we need to kind of have a better understanding because I just don't think those solutions exist yet. And the ground is shifting too quickly.
Yeah.
So whatever we decide to do today, I think will be wrong in not 6 months, but maybe 3 months, for sure 12 months. So we're trying to kind of figure out where we can utilize that and leverage that. So I think the adage I would use is we're going to measure twice and cut once and be thoughtful about it. To the broader question, it's an excellent question. So my general view of AI as it relates to kind of enterprise software SaaS businesses is it's the next evolution. Now, there are certain companies that are more susceptible to AI risk than others. But the fact of the matter is there's 7,000, 10,000 software companies. Thoma Bravo just today, I think, announced that they raised three funds over $34 billion.
I saw that.
So So you can't tell me that AI is going to annihilate every single software company. Like that's nonsensical. There are going to be some companies, like in any industry, that I think will be winners, and some that are going to have more challenges. So we have a very specific lens on how we invest. So if the question is, hey, are you investing in companies that are software developers? No, because that business model, for sure, AI will probably displace. However, there are plenty of software businesses that use AI in their solution that is totally acceptable, right? So again, a lot of people throw the baby out with the bathwater, and it's not as black and white as I think some people are making out to be. You go and you hear some things that some people are saying, and I don't know if they're just trying to chase a headline, but there is definitely an impact on AI. I just don't think it's as extreme to certain companies because all companies are different in this AI risk level, right? So we think there's still plenty of opportunity in software and in technology. And the reason I say that is if you look at where a company will invest in a recession, they may cut CapEx, but what they're going to focus on, and property, plant, and equipment, things like that, what I mean by CapEx.
Mm-hmm.
But if I look at where they will invest, history has shown that they will invest in things that improve productivity or efficiency. And you can get that from technology software. So AI, you can say whatever you want about it, but that's fundamentally not going to change. Now, how it gets implemented, how it gets delivered, how it gets developed, that for sure is moving around. But I do think that there's still significant opportunity. The latest stat I had read was 1 out of every 4 deals today has some sort of technology aspect to it. That's projected to be 1 out of 3. This digital transformation is not going away. And so AI may accelerate some things, may change the landscape, but that's why I go back to the comment I made a couple of minutes ago, which is I think it's the next evolution for enterprise SaaS as opposed to completely wiping out every enterprise software business in the world, which
And I
isn't going
would
to be the
think
case.
that I would also think that there's probably stuff that AI is going to create that we're not even aware of right now and start a new industry or
Right.
subset of an industry that can be underwritten and lent to, and we're not even thinking about it. I mean, we thought of
That's right.
ChatGPT, and then all of a sudden
Yeah.
a faster, leaner version came out pretty quickly.
Yeah. And listen, and to your point, I mean, we don't even know what we don't know yet. And so 5 years ago, for example, everyone said if you want your kids to be successful, make sure they learn programming and coding. Even the guys that said that don't even say it anymore.
Yeah, I
So
know.
whatever people are saying about AI today, um, if they're right, they're going to be lucky because
Yeah.
I just don't know if anyone knows. And even the smart guys agree they don't know. So the folks sitting in the cheap seats, like folks in the investment world, it's going to be difficult to kind of read the tea leaves, in my opinion.
So we have just a couple minutes left. I like to end with a little bit lighter questions
Sure.
as we get towards the end of the episode. So, do you have a favorite sports team and/or hobby?
For those who have heard me on these podcasts before, I do have a hobby. And so my hobby, as bizarre as it sounds, is Japanese fencing. So it's called kendo.
Interesting.
So you basically, it's very similar to fencing, but you use bamboo swords, you wear equipment. And so that's my jam. That's my side hustle. So when I'm not working, I'm doing that.
How'd you get into that? Like, how
Ah,
how did you come to learn
yeah.
or get passionate about that?
Yeah, it's a interesting story. So after I graduated from grad school, I had all this free time on my hands, and so I was like, "Well, what am I going to do?" And I used to play basketball in high school, and I was active just doing things, triathlon, stuff like that. But the problem is when I was graduating out of college, graduate school, I said, I need to figure out something that the older you get, the less of a disadvantage you are. Most sports, most things that you do as you get
Yeah.
older, you can't keep up. So you can't play basketball when you're 50, and if you do, you really shouldn't. You can't play volleyball, but you could golf, right? So golf is one of those things.
Yep.
But I was living in the city, and who has half a day to give up to go golf? And so a buddy of mine said, "Hey, listen, you ever look at martial arts?" And I'm like, "Okay, maybe I will." So I started just looking around the Chicago area of kind of different martial arts. So there's judo, which is a lot of throwing. I'm like, well, that's not going to work. There's aikido, there's karate. So I went to this dojo, which was for kendo, and when I walked in there, the head instructor there was probably at the time 75 years old. And this guy, Todd, he was like Darth Vader on glass. There were 30-year-olds
Wow.
that couldn't touch him. And it
Wow.
wasn't that he was physically stronger. It's just that he could manipulate them, and it was more strategy and chess and technique as opposed to brute raw strength. And so when I saw that, I'm like, hey, this seems interesting. And then I took a class, and then the rest is history. So that's kind of how I got into it.
I would ask one surprising thing about yourself, but I think you've just nailed that. So
Ah,
I'll go to the next
the,
one, which
the,
is one book that you would recommend reading.
Listen, how do you not say like the Ben Franklin biography? Ben Franklin's biography is pretty good. So for folks that haven't read it, I think it's definitely worth a read. I like the biographies. They're always fun.
Most exciting part of your job.
Um, Listen, here's don't tell the CEO that don't tell Ted this. I would do it for free. I really I enjoy it. And listen, at this stage of my career, it's more about the opportunities for the next generation. But this is something. My wife and I have a debate. She always says that you should follow your passion. I say you should follow what you're good at, right? So if you're good at it, then you'll probably make money at it. My passion may be, whatever, but if I can't make money at it, what's the point? But I really have a passion for finance and for what we do, and I would do it even if they weren't paying me. So that's what I like about it.
One final question, one prediction for the next 12 months. Kendo is going to take off.
No, that definitely for sure isn't. What's the prediction I would tell you? I think what's going to happen is because the U.S. is going to go into a midterm election next year, a lot of what the administration's going to do in terms of tariffs and stuff, I think gets resolved by Q3, Q4 of this year. I could be wrong, but I just don't see a lot of the uncertainty in the market lasting kind of around Christmas time, because it's hard to imagine a world where there's no toys at Walmart during Christmas.
That's a good point.
So that's my prediction.
Well, Zia, I really appreciate you spending a few minutes with me. It's nice to meet you, at least virtually. Continued success at Monroe, and hopefully we'll get you back sometime in the future.
Absolutely. We'll get back in a year when you tell me how wrong my prediction was.
There you go. I'll hold you to that.
Yeah, for sure.
Thanks so much.
Good luck. Thank you so much, Todd.
Yep. Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.